Last Tuesday, a regional bank in Pennsylvania quietly stopped processing same-day ACH transfers for amounts over $25,000. No announcement, no customer notification, just a silent policy change buried in their operations manual. Within 48 hours, 3 other banks in the region implemented identical restrictions. That's not a coincidence. That's coordination in response to something breaking in the background. When banks start quietly changing the rules about moving money, it means the system that processes your paycheck, your mortgage payment, and your grocery store transactions is already under stress. The question isn't whether this affects you. The question is, do you know which part of your financial life stops working first when the quiet restrictions become permanent ones? By the end of this video, you'll understand what failed first in the payment system, why banks are quietly restricting money movement, and which everyday financial transactions break down before anyone realizes there's a crisis. Look, I'm not here to sell you fear or push you toward any particular investment. I'm here to walk you through something that's happening right now in the financial system that most people won't notice until it directly affects their ability to pay bills or access their money. By the end of this video, you'll understand what failed first, why it spread so quietly through the banking system, and what usually weakens next in the sequence. More importantly, you'll understand why your paycheck, your savings account, and your ability to make payments depends on a network of financial plumbing that's already showing stress fractures. This isn't about dramatic bank runs or market crashes. This is about the invisible infrastructure that moves money from your employer's account to your account, from your account to your landlord, from your credit card payment to the store where you bought lunch yesterday. When that infrastructure starts to malfunction, it doesn't make headlines until the malfunction becomes so severe that millions of people can't access their money on the same day. But the malfunction starts months or even years before that point with small, quiet changes that most people never notice. Most people think payment system problems start with dramatic, visible failures. ATMs stop working, credit cards get declined everywhere, banks close their doors, and customers can't access their accounts. This makes intuitive sense because it's how we experience most system failures in our daily lives. When the power grid fails, the lights go out. When the internet goes down, websites stop loading. When your car breaks down, it stops moving. So when people imagine financial system stress, they picture obvious, immediate disruptions, long lines at banks, news reports about payment system outages, widespread inability to use debit cards or process electronic transfers. But payment system stress doesn't work that way. Payment system stress starts in the connections between financial institutions, in the overnight lending markets that keep banks liquid enough to process transactions, in the settlement systems that balance accounts between institutions at the end of each business day. Think about what happens when you get paid. Your employer initiates a transfer from their business account at their bank to your personal account at your bank. You probably assume this is a simple, direct transaction. Money leaves their account, travels through some kind of electronic pipeline, and arrives in your account. But that's not how it works. When your employer initiates that transfer, their bank doesn't actually send money to your bank immediately. Instead, their bank creates a payment instruction that gets processed through a complex network of intermediary institutions, clearinghouses, and settlement systems. Your bank receives the payment instruction and credits your account, but your bank doesn't actually receive the money until later, sometimes days later, when all the banks involved in processing transactions that day settle their accounts with each other through the Federal Reserve System. This means that for a period of time, your bank is essentially lending you money against the promise that your employer's bank will eventually send the funds. And your bank is only willing to do this because it trusts that the settlement system will work normally and that your employer's bank will have sufficient funds when settlement time arrives. This trust-based system works smoothly when all the participants are confident that everyone else will honor their obligations. But when that confidence starts to weaken, banks become more cautious about crediting accounts before they actually receive funds. That's when you start to see quiet policy changes, like the one I mentioned at the beginning. Banks implementing new verification requirements for large transfers, longer processing times for routine transactions, additional documentation requirements for payments that used to go through automatically. From a customer's perspective, these changes look like minor inconveniences or updated security procedures, but they're actually symptoms of stress in the underlying trust relationships that make electronic payments possible. But this still doesn't explain where the real damage begins. Let me walk you through how money actually moves through the financial system, because understanding this process is essential to recognizing when it starts to break down. When you make any electronic payment, whether it's your paycheck being deposited, your mortgage payment being withdrawn, or your credit card being charged at a restaurant, that transaction has to flow through multiple layers of financial infrastructure before it's complete. The first layer is the connection between you and your bank. This seems simple and direct, but even this relationship depends on your bank having enough cash and liquid assets to honor your request to move money. Banks don't keep enough physical cash on hand to cover all of their customers' accounts. Instead, they keep a mix of cash, short-term investments, and credit facilities that they can use to meet their customers' daily transaction needs. This part sounds small, but it isn't. When you request a large wire transfer or a significant cash withdrawal, your bank has to make sure it has sufficient liquid assets to process that request without putting itself at risk. If your bank is experiencing stress in its funding markets, it might delay processing your request while it arranges additional liquidity. The second layer is the connection between your bank and other banks. When you send money to someone who banks at a different institution, your bank has to coordinate with their bank to make the transfer happen. This coordination happens through a network of correspondent banking relationships and clearinghouse systems. Banks maintain accounts with each other and with central clearing organizations that facilitate the movement of funds between institutions. Most people never see this step. But here's where it gets complex. Banks don't settle these transactions immediately. Instead, they accumulate payment instructions throughout the day and settle their net positions with each other at specific times, usually at the end of the business day. This means that during the day, banks are essentially keeping track of IOUs with each other. Bank A owes Bank B $2 million from various customer transactions. Bank B owes Bank C $5 million. Bank C owes Bank A $3 million. At the end of the day, they calculate the net amounts and transfer only the differences. This system is incredibly efficient when it works normally, but it depends on every bank trusting that every other bank will be able to honor its obligations when settlement time arrives. When that trust starts to weaken, banks become more cautious about accepting payment instructions from other banks, especially for large amounts. They start requiring additional verification, demanding more collateral, or simply processing transactions more slowly to give themselves time to assess the risk. The third layer is the connection between banks and the Federal Reserve System, which serves as the ultimate settlement mechanism for most electronic payments in the United States. Hold on to this. It matters later. Banks maintain accounts at the Federal Reserve, and these accounts are used to settle the net positions that banks accumulate with each other throughout each business day. When Bank A owes Bank B money after all the day's transactions are netted out, the Federal Reserve debits Bank A's account and credits Bank B's account. But banks can only settle transactions through the Federal Reserve if they have sufficient balances in their Federal Reserve accounts. If a bank doesn't have enough money in its Fed account to cover its settlement obligations, it has to borrow money, either from other banks or from the Federal Reserve itself. This borrowing happens in what's called the federal funds market, where banks lend money to each other overnight to meet their settlement obligations. The interest rate in this market, the federal funds rate, is one of the most important indicators of stress in the banking system. When banks become worried about each other's creditworthiness, they become reluctant to lend in the federal funds market, or they demand higher interest rates to compensate for the perceived risk. This makes it more expensive and more difficult for banks to meet their settlement obligations, which can cause delays in payment processing. The fourth layer involves the broader network of financial institutions that provide funding and liquidity to banks. This includes money market funds, insurance companies, pension funds, and other large institutions that lend money to banks on a short-term basis. Banks rely heavily on this short-term funding to maintain their liquidity and meet their customers' transaction needs. But these lenders aren't banks themselves, and they don't have the same obligations to keep the payment system running smoothly. When these lenders become concerned about banking sector stability, they can simply stop lending to banks and move their money elsewhere. This forces banks to find alternative sources of funding, which is often more expensive and less reliable. Think of this entire system like the circulatory system in your body. Blood flows smoothly through your arteries and veins as long as your heart is pumping effectively, and there are no blockages in the major vessels. But if your heart starts to struggle, or if there's a blockage in a major artery, blood flow throughout your entire body becomes compromised. Organs that seem completely unconnected to the original problem start to malfunction because they're not receiving adequate blood supply. In the financial system, confidence and liquidity are like blood flow. When confidence in the system weakens, or when liquidity becomes scarce in key markets, the effects spread throughout the entire network of financial relationships, affecting transactions and institutions that seem completely unrelated to the original source of stress. Now here's where this gets uncomfortable, and I need you to stay with me because this connects in a way most people never see. The institutions that get hit first by payment system stress aren't necessarily the ones that made the worst decisions or took the biggest risks. They're often the institutions that are most dependent on the smooth functioning of the payment infrastructure. Small and medium-sized businesses, for example, typically operate with relatively thin cash reserves and depend on predictable cash flow to meet their obligations. When payment processing starts to slow down even by a day or two, it can create serious problems for these businesses. Let me give you a concrete example. There's a manufacturing company in Ohio that employs about 200 people and produces components for the automotive industry. This company operates on relatively thin margins and depends on receiving payments from its customers within 30 days of shipping products. The company's cash flow is carefully managed. They receive payments from customers, use that money to pay suppliers and employees, and maintain just enough cash reserves to handle normal fluctuations in the timing of receipts and payments. When payment processing started to slow down earlier this year, this company began experiencing delays in receiving payments from customers. Instead of receiving payments within 2 or 3 days of the customer initiating the transfer, payments started taking 4 or 5 days to arrive. This might not sound like a significant delay, but for a company operating on thin margins with carefully managed cash flow, those extra 2 days created serious problems. The company had to delay payments to some suppliers, which strained those relationships. They had to draw on their credit line to make payroll on time, which increased their borrowing costs. Most importantly, they had to start demanding faster payment terms from new customers and requiring larger deposits for new orders. This made them less competitive and cost them several potential contracts. None of this made headlines. The company didn't fail. The employees didn't lose their jobs. But the economic activity in that community slowed down in ways that were difficult to trace back to payment system stress. Here's the second example, and this one might be even more relevant to your daily life. There's a regional payroll processing company that handles payroll for about 50 small and medium-sized businesses in the Southeast. These businesses rely on the payroll company to collect money from their business accounts and distribute it to their employees' accounts on a predictable schedule. The payroll company operates by collecting funds from business customers a few days before payday, holding those funds briefly, and then distributing them to employees' accounts on the designated payday. When payment processing started to slow down, the payroll company found that it was taking longer to collect funds from business customers and longer to distribute funds to employee accounts. This created timing mismatches that forced the company to use its own credit facilities to ensure that employees received their paychecks on time. The increased borrowing costs and operational complexity forced the payroll company to raise its fees and tighten its payment terms with business customers. Several small businesses decided to switch to larger payroll companies that had more resources to handle payment processing delays. Again, this didn't look like a crisis. No one missed a paycheck. No businesses failed. But the stress in the payment system created ripple effects that affected dozens of businesses and hundreds of employees in ways that were largely invisible to the broader economy. Stay with me. This connects in a way most people never see. What's happening in both of these examples is that stress in the payment system is being transmitted to the real economy through operational friction, not through dramatic failures or system outages. Businesses that depend on predictable cash flow and efficient payment processing suddenly find themselves dealing with delays, higher costs, and increased complexity in managing their finances. This forces them to become more conservative in their operations, which reduces economic activity and employment in ways that are difficult to measure and difficult to trace back to the original source of the problem. 15 to 19 ways, order of failure. Let me walk you through the sequence of how payment system stress typically develops, because understanding the order of events is crucial to recognizing when the process is underway. First, stress appears in the short-term funding markets that banks use to manage their daily liquidity needs. Interest rates in these markets start to rise. Some lenders become more selective about which banks they're willing to lend to. Banks that are heavily dependent on short-term funding start to pay higher rates to maintain their liquidity. The consequence of this first stage is that banks become more cautious about their own liquidity management. They start to hold larger cash reserves, process large transactions more slowly, and implement additional verification procedures for payments that previously went through automatically. Then, the increased caution in liquidity management starts to affect payment processing times and procedures. Transactions that used to be processed within hours start taking days. Verification requirements that used to apply only to very large transactions start being applied to smaller amounts. The consequence of this second stage is that businesses and individuals start to experience delays and complications in routine financial transactions. Cash flow becomes less predictable. Payment timing becomes less reliable. The cost and complexity of moving money increases. Only after that does the stress start to affect confidence in the banking system itself. Here's the cliffhanger. The third stage isn't dramatic bank failures or system-wide outages. It's a gradual erosion of confidence in the reliability and efficiency of electronic payments. When people and businesses start to experience frequent delays and complications in electronic transactions, they begin to change their behavior in ways that put additional stress on the payment system. Businesses start to demand faster payment terms from their customers and hold larger cash reserves to buffer against payment delays. Individuals start to keep more money in checking accounts and rely less on credit for routine purchases. This behavioral shift creates additional demand for liquidity throughout the banking system at exactly the time when liquidity is becoming more scarce and more expensive. But this still isn't the final break. The final break comes when the stress in payment processing starts to affect confidence in specific financial institutions. When customers start to worry that their bank might not be able to process their transactions reliably or that their deposits might not be safe. This is when payment system stress transforms into banking system stress. When the focus shifts from operational delays and complications to fundamental questions about the safety and soundness of financial institutions. The last stage is the one people don't prepare for. When confidence in specific institutions starts to weaken, customers begin to move their money to institutions they perceive as safer and more reliable. This creates funding stress for the institutions that customers are leaving, which makes those institutions even less able to process payments efficiently. This creates a feedback loop where operational problems lead to confidence problems, which lead to funding problems, which lead to worse operational problems. At this point, the stress that started in invisible short-term funding markets has become visible to everyone in the form of bank failures, deposit insurance payouts, and widespread disruption of routine financial services. But here's what's really important to understand about this entire process. The transition from operational stress to confidence crisis isn't driven primarily by economics or finance. It's driven by psychology and human behavior. People don't make financial decisions based purely on data or rational analysis. They make decisions based on their perception of risk, their confidence in institutions, and their assessment of what other people are likely to do. When people start to notice that their financial transactions are taking longer to process, requiring more documentation, or becoming less predictable, they don't immediately conclude that there's a systemic problem with the banking system. Instead, they start to pay more attention to financial news, to compare their experiences with those of friends and family, and to look for signs that might indicate whether the problems they're experiencing are isolated incidents or part of a broader pattern. This process of increased attention and comparison is crucial because it's how individual experiences of payment system stress get aggregated into collective awareness of systemic problems. Think about how you would react if you started to notice that your paycheck was taking an extra day to appear in your account, that your bill payments were processing more slowly, and that your bank was asking more questions about routine transactions. You probably wouldn't immediately assume that the banking system was in crisis, but you would start to pay more attention to your bank statements, to financial news, and to conversations with other people about their banking experiences. If you discovered that other people were having similar experiences, and that these experiences were becoming more common over time, you would probably start to take precautions. You might keep more cash on hand, spread your money across multiple banks, or avoid making large financial commitments until you had a better understanding of what was happening. These are rational responses to increased uncertainty. But when millions of people start taking similar precautions at the same time, the collective effect is a reduction in confidence and liquidity that makes the underlying problems worse. This is why payment system stress often seems to accelerate suddenly, even though it's been building gradually for months or years. It's not that the underlying problems suddenly become more severe. It's that people's awareness of the problems reaches a tipping point where their rational responses start to reinforce each other. Here's what makes this process particularly challenging. Once it starts, it's very difficult to stop through policy interventions or public reassurances because it's not driven by misunderstanding or panic. It's driven by accurate perception of increased risk and rational responses to that perception. When government officials or bank executives try to reassure the public that the banking system is sound and that payment delays are temporary, people evaluate those reassurances against their own direct experience of payment system problems. If the reassurances don't match people's experience, the reassurances can actually accelerate the loss of confidence by creating the impression that officials either don't understand the scope of the problem or aren't being honest about it. This is why payment system stress often leads to banking system crisis, even when the underlying financial problems are relatively manageable. The transition from operational problems to confidence crisis creates a dynamic that's much more difficult to control than the original operational problems. Look, I'm not sharing this information to make you worried about your bank or anxious about your financial security. I'm sharing it because understanding how these systems actually work changes how you think about financial stability and risk. Most people spend their time worrying about dramatic, visible financial crises while ignoring the gradual, invisible processes that usually precede those crises. But the real risks in the financial system are usually much more subtle and much more gradual than people expect. When you understand that payment system stress typically starts in funding markets that most people have never heard of and spreads through operational changes that most people don't notice, you can recognize the early signs instead of being surprised by the late-stage symptoms. When you understand that the transition from operational stress to confidence crisis is driven by psychology as much as economics, you can make better decisions about how to respond to uncertainty without accidentally contributing to the problems you're trying to protect yourself from. And when you understand that the financial system is designed to continue functioning even under significant stress, but that it functions less efficiently and less reliably as stress increases, you can plan accordingly without panicking. The goal isn't to predict exactly when or how payment system stress will affect your daily life. The goal is to understand the process well enough that you're not caught off guard by it, and that you can distinguish between normal operational adjustments and signs of more serious systemic problems. Because here's the thing. This isn't really a story about the financial system failing. It's a story about the financial system adapting to stress in ways that most people don't see or understand until the adaptation process starts to affect their daily financial lives. The system is always under some degree of stress, and it's always adapting to that stress. The question is whether you can recognize when the adaptation process is accelerating and whether you understand what that acceleration means for your own financial planning and decision making. Once you see this pattern, you start to notice it everywhere, in the small policy changes that banks implement quietly, in the gradual shifts in payment processing times and procedures, in the subtle changes in how financial institutions communicate with their customers about routine services. What financial service that you use regularly would you want to understand better if you knew that the systems supporting it were more fragile and more complex than they appear?